Welcome, everyone. This is Dr. Bill Seeger, Director of the Corporate Education Program at the College of Business at the University of Texas at Arlington. This is the third session of our summer webinar taxation series, and we are honored and we are very happy to have Dr. Bruno Silva from the University of Amsterdam join us today to discuss the hottest area of international tax since 2015, and it will continue forward. And that is the BEPS initiative in the digital economy. So that's what we'll be talking about today. But once again, welcome to my great friend and colleague, Bruno Silva. Welcome.
Thank you very much, Bill. First of all,
go ahead.
Big pleasure to be here with you and with everyone. And thanks everyone for attending.
So thank you, Bruno. So let me give a little background on our corporate education program. We've been around about a year. We serve the Dallas-Fort Worth area. We bring the finest in executive education to our community in DFW. And that's one of our goals is executive education, either tailored programs or individual programs for companies, corporations in the DFW area. We also bring the latest of the College of Business research, and we bring it to you via these webinar series or other modules so that you can be apprised and are able to apply the latest research from our College of Business. And finally, we support the community in any way, shape, or form. And in May, for example, we hosted our COVID-19 series and its impacts on our community. So that's one way we've established outreach for the Arlington, Fort Worth, and Dallas communities. So with all that in mind, I wanted to give you some background on Dr. Bruno Silva. He is truly a leading light in the area of international taxation. Currently, he's the assistant professor at the University of Amsterdam, an adjunct professor at the Texas A&M Law School. He is a tax advisor for Loyns and Loeff, which hopefully is close enough to the correct pronunciation.
It was perfect.
Largest law firm, and probably their largest law firm in terms of taxation as well in the European theater. Once again, like many of my prior guests, we would have to use a ream of paper to list out all his accomplishments. So let me be brief. He has his PhD from the University of Amsterdam in international tax law. He has his LLM, which is his master's degree in international tax law from Vienna University, and I believe his undergrad in law from the University of Lisbon. He has many accolades, honors, etc. He advises the government of Macau. He advises the OECD, but they seem to ignore him, much to our dismay. And today he'll be talking about BEPS. As I've told you in some of my previous announcements, we hope Dr. Silva brings balance to the force in his discussions today. There's clearly a dark side, but Dr. Silva does not represent that in this debate. So we all are anxious to hear the good word from Dr. Silva. So with that, Bruno, thanks again, and please proceed.
Thank you very much, Bill. Or should I call you Master Yoda?
Yes, call me Yoda.
Well, once again, thank you so much for inviting me. It's a great honor and a pleasure. And yeah, I will also be doing some other lectures for you in your program at UTA. Well, thanks once again, everyone, to be here. First thing I would like to say is this is a difficult topic. So the issue of taxation of digital economy is a difficult topic, which you may understand the reason why. First, because it's very much a topic of the moment in terms of development of business. I mean, especially with COVID, it became even more important. I mean, many people are basically doing all their shopping online. And secondly, because it involves a lot of money. I mean, we are talking about some of the biggest and most profitable multinationals in the world. When you look to my slides, you're going to see a little bit of technical content, and I try to balance with a little bit more information on what are the developments, what is the position of the US on this as well, and what is the position of the OECD, which is the Organization for Economic Cooperation and Development. So it's the leading organization to which the United States is also a member that is leading this project. So that we can have a feeling of what we can expect either in the end of this year or beginning of 2021. Either you're involved in international taxation or not, and of course, the vast majority of the people here do US taxation or will be doing US taxation. This is a topic that will directly or indirectly touch upon your life. So it's a really important topic. I am going to start sharing my screen. So I'm going to ask maybe if Mike, you can maybe remove your screen or I can go on top of yours. Yeah. So let me see if I can do it. Microsoft PowerPoint. It should be this one. Let's see again. Sorry, somehow I'm unable to share the screen. Can Mike do it for me, or maybe you, Bill,
should
can
be
do
able to. He has the slides.
Oh yeah, I can do it now.
Oh,
I solved it. Sorry, something happened. I don't know what, but I was able to do it. Okay. Slideshow. Here we are. I think everyone can see.
Looks good.
So the topic is, well, the topic is BEPS, digital economy, nexus, transfer pricing, and tax treaties. I mean, it's a very broad topic. And I think if you would like to cover in detail digital economy, probably we would need, I would say, at least between 9 to 12 hours to discuss a little bit more into detail these issues. So this will give you a first flavor. And yeah, if you want more, maybe Bill and I can do something at UTA at a later stage with dealing more concretely with the topic. I mean, the issue of digitalized business, the underlying issue, I think it's clear to everyone. So essentially we have both new forms of business and also ways that replace traditional business and which are digital. I mean, you have examples here of Amazon or Booking.com or Uber that replaced traditional ways to perform a business, or they came with alternative and new ways to perform business. And this creates a whole bunch of problems from the perspective of taxation, because essentially all the underlying premise for taxation of international business involves physical presence. Actually, to be honest, even domestically. So the current nexus, so the current link between a certain taxpayer and the jurisdiction involves physical presence, somehow, some sort of. It can be through incorporation of a subsidiary or setting up a branch. The way that you allocate the profits to a certain jurisdiction, a certain country, are based on transfer pricing rules, the traditional ones, so essentially the arm's length principle. The allocation is based on also the traditional paradigm of where functions are performed, assets are used, and risks are assumed. When we're talking about functions performed and assets used, again, we are talking about physical presence. So there are several arguments that support the need to come up with new rules. First, what I started by saying, we have digital transformation. So the existing rules don't work anymore. So they cannot capture the new ways of doing business. When we talk about taxing Booking.com, well, where are they physically present in a certain country developing the business? They are not. So how are we going to do it? And how much profit we're going to allocate? Then we have, you're going to see later in the slides, but you see that several countries started enacting unilateral measures. So they start saying, well, we have a whole bunch of revenue that we're losing and we're not able to tax. So the only way that we can tax this is if we come up with measures unilaterally. And the problem when you adopt unilateral measures to business that carry their activities worldwide is that probably going to have multiple taxation. So all the countries either adopting identical measures or different ones, they're going to tax those businesses multiple times. So, and every time you tax a business more than once, then you have a double taxation problem. And then you have the increase in audits and tax disputes. So if you have multiple taxation, it's normal that multinationals are going to complain because nobody wants to be taxed 2, 3 or more times on their business. So problem of digitalized business, new ways of doing business, they don't involve physical presence. How are we going to tax them? And then the amount, because the way to allocate profits is the arm's length principle, and the arm's length principle also requires presence because it requires functions, performance of functions, use of assets. Now, if you think this is only an international problem, well, it's not. So I told you that even on a purely domestic perspective, you can have the issue. And that is why I brought you, probably many of you know even much better than I do, the Wayfair case. So it's a case in which the US Supreme Court issued a judgment on June 21 of 2018. So it's a pretty recent case. So the starting point is that South Dakota in 2016 enacted legislation, new legislation that wanted to, the idea was to fill that gap of I need to have nexus, I need to be entitled to tax for businesses that act remotely, that act on a digital basis. So the only way I can do this is by enacting new rules because the old ones don't work. So the new rules say the following. South Dakota is entitled to tax on sales tax, we are talking here about sales tax, when either of one of two conditions are met for businesses located outside South Dakota. So more than $100,000 in annual sales performed in South Dakota, or if the business at stake engage in 200 or more separate transactions. So if you have some company from California that would meet one of these thresholds, they would be taxed in South Dakota, even without physical presence there. So this legislation wanted to fill a gap and therefore contradicted previous decision of the US Supreme Court of 1992 that said, in order to be able to charge sales tax, I need to have a certain nexus, and that nexus is determined essentially with all these possible criteria, all of them involving physical presence, inventory, real property, agents or personnel, conducting services locally. All that is there involves physical presence. So there was an appeal against these rules by saying, well, they're unconstitutional. They contradict the 1992 decision that says I can only tax if I have physical presence. the first ruling by the South Dakota Supreme Court was to say, indeed, this is unconstitutional. However, the US Supreme Court, in this famous decision of June 21, 2018, overruled the decision of the South Dakota Supreme Court and said, well, actually, what South Dakota did is right. So they say, it's true that in 1992 we ruled that in order for sales tax, you need physical presence, but the world changed. So we need to change as well. So the law was accepted. So it was in a 5-4 decision in favor of the South Dakota state. I invite you, if you want to read, because you see the arguments, the pros and cons of accepting a law or a nexus that doesn't involve physical presence, but the ultimate decision by the Supreme Court is that you can have nexus for sales tax purposes even without physical presence. So South Dakota is okay. So the problem that you see in this decision is exactly the problem that is happening a little bit all over the world, is that we need to modify something, and how are we going to do it? So we understand, I think everyone understands that probably unilateral actions create problems because they may lead to double taxation. So the coordinated approach to try to implement identical measures with a certain coordination among countries on a global perspective has been the work of the OECD. Now, as Dr. Seeger said in the beginning, everything started in 2015. So there was this base erosion and profit shifting project that in October 2015 came up with 15 actions. Those 15 actions dealt with different issues. One of them, taxation of digital economy. So you have here this October 2015 Action 1 report. However, that report materially had nothing. So the only thing that the report said was, well, first, they identified that there are different ways to perform a business. Second, identified the problems of the existing rules. Third, said there are different forms that we can address this, but we need to study more. And since then, until this moment, there were different reports and drafted reports being enacted that have been discussing, analyzing, and trying to come up with the final solution to address this. And I will tell you in a moment what is the most likely to be the final solution and the complexities that involves. So we start in 2015, and since then until today, which is 15 July 2020, we don't have a solution yet, but the overall design of what will be the solution should come soon.
So Dr. De Silva, the timeline there is specifically concerned with the Article 1 digital economy, correct? Just so people understand the complexity and all the work, and we still say don't have a decision.
Yes, exactly. So the BEPS project, which goes beyond digital economy, started in 2013. Then there were several reports that were issued between 2013 until the final reports in 2015. One of the BEPS issues, base erosion and profit shifting issues, was Action 1. Action 1 dealt specifically with digital economy. And that one was the only of the actions that didn't come up with solutions because it was so complex. And since then, we are talking roughly about 5 years, there was no solution yet. So it's highly debatable. You're going to see in a few minutes that there have been a lot of tensions, especially between the US and other countries. And okay, you can think why, because the US actually headquarters the majority of the most relevant multinationals that are dealing with this. Amazon. So some of the major players, or most of the major players, are in the US. So the position of the US is essentially they are trying to protect their multinationals. So you see that we have all these reports, no solution yet. So I can say that the premise, the underlying premise of Einstein probably doesn't work in this case. So Einstein said, if I had an hour to solve a problem, I'd spend 55 minutes thinking about it, the problem, and 5 minutes thinking about solutions. I think with digital economy is the other way around. In 5 minutes, we can understand the problem, but we need 55 minutes to try to come up with the solutions. It's exactly the other way around. The problem is very easy. The rules that we have don't work. The solutions for it is these ones that we don't have. And you can imagine there's a lot of time pressure for different reasons. I mean, first, because from all the BEPS actions, the only one that was not solved in 2015 was digital economy. Second, because there is a lot of public understanding that these types of companies receive a lot of profits but are not sufficiently taxed. Third, you have the COVID-19 effect. So, I mean, the US is probably the biggest example that there was significant intervention by the US government at the federal level in the economy, injecting a lot of money. And of course, I mean, we know how it works. If the government injects money, they need to collect it. And the only way to collect it is through taxes. So they need revenue. Governments need revenue. So the only way that they can collect this revenue is through taxes. So they need to find a solution for this. Eventually, the solution is more clear in terms of, let's say, the skeleton. The problem is that the meat of that skeleton is still unclear. So what's going to happen, or what's likely to happen? The way to address digital economy, first premise is that they said, and that is also an opinion of your secretary, Mnuchin. He always said, digital economy, it's not exclusive from digital business. It's a broader perspective. We should not ring fence. So it should try to find a solution that works for all sorts of businesses. So what we have now, it's two pillars. The OECD solution that is being discussed is two pillars. One pillar, pillar one, will have three amounts. Amount A, which will be the new taxing rights. So amount A is going to be the amount that will actually catch the digital economy profits that are not being catched so far. So they want to create something new taxing right in which doesn't depend on physical presence. So no need to have physical presence there. And they want to use a sort of formula. Then there will be amounts B and C. Yeah.
Dr. Silva, excuse me 1 second. For our guests and audience, you talk about a new taxing right relative to what, an old taxing right, or could you just describe what is?
So actually, it's a new taxing right because we are creating something new that was not there. So the understanding is we don't have rules that allow to tax digital economies businesses. What we have doesn't work. A little bit what South Dakota did. We cannot tax remote sellers. We need to create new rules that allow to tax remote sellers. It's a little bit what they're doing here. The rules that we have don't allow us to tax. We need to create something new. And this new is something that is independent from physical presence. So we don't need to be present in the country in order to tax the business.
So it's really a debate over what would I say, source, versus home country, more than it is we don't have a way to tax a company without physical presence. Because the companies get taxed, like Google gets taxed in the US, it's just that France doesn't get any of the revenue that they derive there. So isn't it really just an argument over, source versus, as I say, home country?
Yeah, I mean, okay, that's a good question. The issue is what the underlying premise under the BEPS project was taxation should occur when business activity is being carried on. So if we have, for instance, booking.com or Facebook, and Facebook is collecting money from advertising in France or Google, then the economic activity is the advertising in France. So the premise will be, then France should be allowed to tax. So it's what you say is a sourcing issue. So amount A is the new thing. Then there's amount B and amount C. Amount B wants to set up a fixed return for marketing and distribution functions. So we're talking here, you're going to see later about low risk distributors. So people that buy products from the manufacturer and sell it in their home markets to third parties. So how much remuneration should those low risk distributors have? And then you have an amount C that says something like this. If a multinational under amount A and B was not taxed sufficiently, then we still have amount C that can adjust and tax whatever was not taxed before under the two previous amounts. It's complex. How is all of this is going to interact? We don't know yet. And there's the strong likelihood of double taxation. So that amounts that are caught under B and can also be caught under C or under A. There's a lot of possibilities of overlaps under this amount. Now, apart from the pillar one that deals with these digital businesses, then there was something new, which is pillar two. Pillar two is called the GLOBE, meaning Global Anti-Base Erosion Rules. And the GLOBE, pillar two, is basically a combination of the US GILTI and the BIT rules. So the idea is to achieve, on a global perspective, a minimum income taxation for multinationals. So every time a certain amount of income, foreign income, is not sufficiently taxed, then there is a possibility of the other country to catch back that amount and top up the taxation, the lower taxation. It's exactly, for the ones that are familiar, the GILTI and the BIT combined. You're going to see later, but it's the same thing. So global income that is low taxed under the GILTI, and then the BIT, the perspective of source, payments that erode the tax base and they are not sufficiently taxed in the other country. So pillar two, as you can see, has even a wider scale because it aims to deal with all other BEPS issues. So it's not exactly from digital businesses, but it goes beyond. Everything that was not sufficiently taxed will be taxed. Now, whatever this minimum income taxation means, we don't know because there's no reference yet of what will be the threshold for minimum taxation. The discussion may be 10%, 12.5%, maybe 15%. It will be something around these three figures. So two pillars, one more focus on digital business, pillar two, minimum taxation of global income.
Maybe you're Dr. De Silva. Are you going to talk about the amount C in some detail? Because it's, I don't want to steal your thunder. It's highly controversial to a transfer pricing economist like myself. You know, you're talking about separate entity, formulary apportionment. Are you coming to those controversies? If so, I will be quiet.
No, I actually amount C, I will not talk about it because it's the most traditional, let's say, TP analysis. So I will focus on amount A and on amount B and leave amount C aside, but you can, of course, give your thoughts on this. So I will start.
Well, I wouldn't call it traditional at all. I mean, it's not an arm's length based allocation of the residual. It's a formula based. So that's what I meant, is in terms of it being very controversial. And
Yeah, yeah. I mean,
yeah,
they introduced this has not been the new part. The new part would be on the amount A and B. B
okay,
being, as you say, well, they said it's the arm's length principle, but it's going to be a fixed return,
yeah.
which is, yeah, also debatable.
So,
But
okay, thank
but
you.
let's see. I mean, this slide represents just another way to introduce the pillars. So I will skip this one, and you of course can read it later. So I'm going to tell you how amount A is going to be determined. Again, this may be a little bit complex, but the chart on the right is the chart that you can find on the 29 and 30 of January 2020 report of the OECD on how amount A will affect multinational enterprises. So we have a series of tests. So the first test is going to be the turnover test. Only multinational enterprises with a global revenue threshold that equals or exceeds 750 million euros, 750 million euros will be taken into account for amount A liability. I don't know how this translation in terms of US dollars, but it's the same threshold that you apply for country by country reporting. Then that's the first. So only the multinationals that have the global revenue threshold of that equals or exceeds the 750 million euros are targeted. All the others are out. Second test, you need to have in-scope activities. So the activities test means only two types of activities are targeted: automated digital services and consumer-facing activities. When I say only two, it's a little bit ironic because, as you may imagine, consumer-facing activities can be everything. Every business that has a consumer and sells to the consumer is potentially targeted. So one of the current challenges is to develop a definition of what is an automatic digital service and what is a consumer-facing activity, because we will need to come out with a definition for this. Then there is a third test, the de minimis test on in-scope revenues. So all in-scope revenues from aggregated consumer-facing activities or automatic digital service activities exceeding a certain amount of euros are targeted. Then you have the business lines profitability test, which I will not even discuss. Then you have the minimis test on aggregate residual profits. You also have a test on percentage of foreign activities. So only when you more than 10% of your revenue derives from foreign activities, you will be targeted. And then, even if all of this is met, you still need to meet the nexus test. The nexus test in each market jurisdiction. What is it? I need to meet a certain revenue threshold consistently on a certain jurisdiction. So I check all this, and then the idea of the nexus is how much is going to be taxed in that jurisdiction. The idea is this: I need to meet the revenue threshold, which will vary from country to country, from jurisdiction to jurisdiction, because imagine, if I have a revenue threshold of $20,000, maybe in a small African country is a lot, but for US it's nothing in terms of the dimension of the market and the consumer power of that market. So this nexus test is going to vary depending on the jurisdiction. And the idea is that you need to meet that local threshold, again, varying from country to country. It should be met consecutively for 3 consecutive periods of 12 months. So they're going to set a minimum from country to country, and I need to meet that minimum for basically 3 years, always, consecutively. And then for consumer-facing businesses, they're going to include what they call plus factors. So not only the revenue threshold, but also some sort of presence there, like targeted advertising or some sort of presence in the market. So something that is being discussed. So you need all these tests, and you can see how complex this is, because think about it. I mean, from a tax administration that is sophisticated as the US, probably this is easy. But think about any other country in the world with a small tax administration, how they're going to implement this. So this is until you get to the nexus point. Now, other issues about Amount A. What are the carve-outs? So what kind of activities that essentially are going to be automatically excluded? Natural resources, financial services, international air and shipping, and then the new one that was added recently, I think in April, they are to sale and leasing of residential property. Here we are talking about construction and sale. We are not talking about brokers. So if you're talking about brokers, people that intermediate for the leasing or the sale, like imagine Booking.com, those are not carved out. Then another issue to be discussed that is being discussed is revenue sourcing. Okay, I know that my in-scope activities are automated digital services and consumer-facing businesses. Now, how do I know to meet the local threshold that actually the activity was carried there? Imagine I order something online. How do I know? So the idea is to develop some sort of criteria like the IP address, the delivery address. All of those can be rules for revenue sourcing. Then implementation. And think positively. If many of you now are thinking this is very complex, think the other way around. Think that we are the first ones dealing with this. We're going to know how to deal with this, and we will have a lot of work in the future dealing with this. So the positive side is that we have a lot of work ahead, because I'm going to tell you the implementation, how it's going to happen. So in terms of the implementation, they are thinking about a new multilateral instrument. So it's going to be a sort of an international agreement with a whole bunch of detailed rules, like, for example, what is a consumer-facing business? How do you determine amount A, and so on, that every country in the world can join and sign in. So everyone will join that multilateral instrument in order to implement these rules. Apart from changes in domestic law, then you also need tax certainty. So we discussed that there's the likelihood of disputes, of double taxation. So the idea is to have an instrument, also multilateral, that can allow to prevent and resolve disputes. Now, one of the things that is being considered, again, for the transfer pricing nerds in now attending this, is the following. To develop a sort of self-assessment forms or returns that allow on a preliminary stage, a little bit like an APA, but it's not an APA, but a little bit like the APA, a multinational can submit this return and say, this is the way that I'm going to calculate my amount A, which is the new taxing right, and provide us documentation supporting it. So they will fill this self-assessment form, so provide the documentation, and this self-assessment form will be standardized on a global perspective so that all the tax administrations potentially involved, imagine Google will fill this, and I mean, Google has business all over the world, so this will impact, let's imagine, India, France, Spain, Canada. So all of these administrations can check and exchange information among themselves to check if the way that Google is determining the amount is appropriate. Just through this slide, you can see the amount of work here. Compliance work, all the work to calculate and all the amount A, more legal work in terms of implementation mechanism and how this is going to work. So a lot ahead to discuss in the future. Then you have amount B. Amount B is to set up a fixed return for low risk distributors, these LRDs. Why? The idea is that we should provide certainty, and apparently a large percentage of mutual agreement cases are dealing with low risk distributors. The MAP, so the mutual agreement procedure cases, basically is the mechanism that through international agreements, the United States with its other treaty partners solves international taxation disputes. The method should be a fixed return. One of the questions is that this is going to be based on a margin, or is it going to be a single point? And is also how we're going to implement it once again. For instance, one of the questions is the remuneration of low-risk distributors is typically one of the subjects for an APA. Frequently, you ask an APA for this. So if you come with a new rule, what is going to happen with previous APAs that you got? Will they going to be grandfathered? So being, okay, you have that APA, while that APA is in force, you're safe, or you need to come up and apply this fixed return once again. And then you have the tax certainty issue once again. We need a mechanism to prevent disputes. To have this MAP, mutual agreement procedure, implemented worldwide. Think about this issue. The United States has a tax treaty network of roughly 80 tax treaties, maybe even less, but 70, 80. So there are more than 100 countries in the world. So for sure, there are many countries that with which the United States doesn't have a tax treaty with. So the idea is to have a multilateral instrument, once again, independent from tax treaties, that has this mutual agreement procedure in which all the countries can join and somehow overcomes the limitation that many countries don't have tax treaties among themselves, so they could not solve the disputes that will arise because there won't be a mutual agreement procedure mechanism in force. So this new multilateral instrument will allow to have a multilateral mechanism to solve disputes, even for countries that don't have tax treaties concluded among themselves.
Dr. De Silva?
Yeah.
Dr. De Silva, we have a question from Emily Silva. I don't know if you're a relative, she's a relative, but Mike Wallman could repeat the question, please.
Yes, sorry about that. The question is, would this taxation type result in lower tax rates because of the competition of countries wanting to win the investment of companies to do business in their country?
Very good question, Emily. Well, it would be always a good question because you're a Silva as myself, but it's really a good question. I'm going to address your question in the next slides. Why? Because I think that this is an issue that can be targeted under the Pillar 2. So potentially all the countries can lower their tax rates. Now, under Pillar 2, as we discussed, I'm going to put it here, actually the next slide. Under the Pillar 2, the idea is to have, you see that circle, income subject to a minimum rate. So the red circle in the middle. So there may be competition to go down, but it will not go too low. What I'm going to tell you later as well is that I think that the US has a competitive advantage compared with all the other countries in the world if the proposal from the OECD for Pillar 2 goes ahead as it is planned. So let me try to come back and explain this. So I told you in the beginning that Pillar 2 corresponds to the guilty and the beat. that the US already implemented. So the US is not going to implement the GLO proposal because they say we have it already. It's the guilty and the beat, because basically it's a copy. Now the design of the proposal is the most important. And I think that the US has an advantage, which I'm going to explain you later. So for the time being, answering to your question, so actually it's not Emily Silva. Silva is the husband of Emily Silva. So sorry for that. But well, you have a Silva at home, it's equally valuable.
Right.
So Emily's husband, answering for now to your question, there is likelihood of lowering the tax rates. They will not be able to go too low because of Pillar 2. And let's see how it works, and then we can come back to your question if I'm not clear. So Pillar 2, we want to achieve minimum taxation. This will be based on 4 rules. 2 rules from the perspective of the state where the headquarters are located, the parent company, and 2 rules from the perspective of the source of the payment. So the first 2, the income inclusion rule and the switchover clause rule, are from the perspective of the parent company. The subject to tax rule and the under tax payments rule are from the perspective of the source of payments. From a broad perspective, these rules will be implemented by way of changes to the domestic law, guilty and the beat, an example, and tax treaties. So US tax treaties could be potentially affected by this. And would incorporate a sort of coordination to avoid that both the state of the parent and the state of the source react at the same time, because if they do, you're going to have double taxation. Imagine if I say I include the income because I'm the parent company, and at the same time the source says I don't allow the deduction of the payment, then you will have double taxation. So we need some sort of coordination. And for now, the trend is going to be that the income inclusion rule is going to be the primary rule. And the income inclusion rule works like this. A minimum worldwide tax by including the income of a foreign branch or controlled entity in the tax base of the controlling entity. Basically, it operates like CFC rules or like your subpart F of the IRC. So for the ones that are familiar with subpart F of the Internal Revenue Code, the income inclusion rule would operate more or less like that, but broader perspective, because subpart F is based on the types of income. Here is just based on how much was taxed, if it was sufficiently taxed. So this will be the priority. So typically, it will be to the state of the parent that will catch the insufficiently taxed income. From a tax treaties perspective, you could have a switchover clause. This is not so relevant from a US perspective, because the switchover clause only applies for countries that adopt the exemption method to relieve double taxation. I mean, the US is clearly a credit system. I mean, you have, I think, sections 901, 902, and 904, if I'm not mistaken, of the Internal Revenue Code. So those are typically the rules for your direct and indirect credit. So this applies on a very limited basis, the switchover rule. But basically says the following: if I receive income from abroad that was not sufficiently taxed, under the tax treaty, I'm not going to apply the exemption. The exemption means I'm not going to tax the foreign income, because if that income was not sufficiently taxed already, so I'm going to switch to a credit. Switching to a credit, it means what? I'm going to tax and provide a deduction for the income that was taxed abroad. So this is how to switch over, but again, this is less relevant from a US perspective. Now, the income inclusion, so the column on the left is to the parent state. Column on the right is for the source state. So tax on base erosion payments. The other tax payments rule, domestic based. It says I'm not going to allow a deduction of a certain payment if that payment is not sufficiently taxed from the perspective of recipient of the income. Very easy to understand how this prevents base erosion. Typically what you do with financing. So I have a financing company in a low tax jurisdiction. I grant a loan to a company in a high tax jurisdiction. So the interest payments are deductible. And if you have a jurisdiction with a 30% corporate income tax, I mean, if you deduct the payments, it means tax you're not going to pay because you're reducing your profits, right? So then you're shifting income from the high tax to the low tax because the interest, which is income, is going to the low tax. So you erode the tax base. You shift income from here, high tax, to here, the low tax. So you're shifting the income to that jurisdiction. So the idea is that I'm not going to allow the deduction at the source if income is not sufficiently taxed at the level of the residence. From a tax treaty perspective, this will mean that I'm not going to apply certain tax treaty benefits. So the reduced withholding taxes under the treaties will not be applicable if the income is not sufficiently taxed and perspective of the recipient. But again, the undertax payment rule is the beat, income inclusion rule is the guilty. Basically, it's how it works. Now, there are a lot of dispute on this. I'm not going to bother you too much because I still want to cover the gossips part of the digital economy, and the gossips are always the best. But there are a whole bunch of technicalities. How I'm going to determine the tax base, carve-outs, scope, related party definitions. The only one I want to touch upon briefly is the blending. As I said to Emily's husband, I think that in this part, the US has an advantage. What's the idea of the blending? Is to look to the income that a multinational enterprise receives from abroad, and the blending is relevant for the income inclusion. And the idea is to see how far I can combine high tax and low tax income from different sources to determine the effective tax rate. So my goal for the income inclusion rule is I need to achieve minimum taxation for an amount of income, right? So I want to include at the level of the parent income that was not sufficiently taxed abroad. Now, if I have the option of blending, mixing high tax and low tax income, it means that when I mix it, if I do the blending, if I combine it, ultimately what I can achieve is that my overall income that I receive from abroad, I compensate the high tax with the low tax. It means that if that overall blending achieves that what is the minimum tax, the minimum tax, it means that I don't have income inclusion, right? So I mix low tax and high tax from abroad, that achieves the minimum, being that 10, 12, 12 and a half or 15. If I get to that minimum, then I don't have income inclusion because I'm going to say, wait, this was sufficiently taxed, right? Now, the key point for me here, when I think from a US perspective, is what is the level of blending? Because there are three possibilities. Worldwide blending. All the income that I received from any source, I can combine it. So I am Google in the US. I can combine all the income I receive from all over the world and check if it was sufficiently taxed or not. Then I can have jurisdiction blending. I'm going to check country by country how much that income was sufficiently taxed. And then I can have entity blending. I check company by company, subsidiary by subsidiary that I have abroad, if that was sufficiently taxed or not. You can imagine that if I go to entity blending, the chances of having income inclusion are higher because I can always have a certain entity that was not sufficiently taxed on a certain amount of income. if I go to jurisdiction blending, there are less chances, but still some. The worldwide blending is the best scenario because I can mix everything. Now, the position of the OECD appears to be to go to the OECD and its member countries seems to go towards the jurisdictional blending. Now, the guilty is worldwide blending. So the US approach under the guilty is we're going to combine all the income that we receive from all over the world and see if that was sufficiently taxed or not. And if not, we're going to check which income was not and bring it. So I think that this places the US in a considerably better position when we talk about the implementation, because US multinationals have less chances of seeing its income included in the US and taxed in the US. And from a tax planning perspective, it's great, because what you do as a tax advisor is to say, bring everything to the US. I'll be in charge of all your tax planning structures. So I'm going to look to the whole presence of the company in the world and start planning and say, okay, well, this company here, maybe we can move it to another country because we can combine it with country X, Y, and Z and Z and obtain ultimately a perfect scenario where we don't have income inclusion. So I think there are a lot of possibilities here to discuss in the future. What I can tell you, and that's for sure, there is no consensus yet. So we discussed the OECD proposal. The United Nations are waiting for the proposal of the OECD. The European Commission from the European Union, they have submitted already a few years ago their own position. So they have a proposal with a short-term and a long-term solution. And then we have unilateral measures. So unilateral taxes being adopted, mostly a digital services tax, which has been causing a lot of controversy. I will skip this. This is the position of Treasury Secretary Mnuchin, saying we need to have a worldwide consensus, because what's the problem? The problem is, so the US saw the design of digital services tax that France and many other countries have adopted, and they started this Section 301 investigation. So if you go to the offices of the POTUS, you will see that there is there Section 301 investigation dealing with DST, Digital Services Tax. So there was an investigation that started in July 2019 in France, and then 11 others in the 2nd of June 2020, so very recent. Austria, Brazil, Czech Republic, European Union, so Commission proposal, India, Indonesia, Italy, Spain, Turkey, and the United Kingdom. So the position of the US basically is this one. We think that the digital services tax, so a tax based on digital transactions, not a tax on income, or at least it's debatable if it's on income or not. There's also discussion on that, something to explore maybe later. They say DST is discriminatory because they say it aims at targeting US multinationals and not others. It's applied retroactively because in many countries they're applying this with retroactive effects. And it's a unreasonable tax policy because it comes from unilateral measure and not coordinated approach. Now, 10 of July 2020, this is the last development, the US concluded the Section 301 investigation against France and said, we think this is unreasonable. So they're going to impose additional 25% duties on French products, which are in the Annex A of the notice. I have to be honest, if you read this notice, and it's available on the website, the Annex A only talks about codes because it should be the US import duty code. So I don't know what they mean, but you can check. In any case, this is suspended. So they suspended the collection for 183 days until 6 January 2021. So I think this is basically a US threat saying, watch out, France and all the others, sorry, this list, and many others that are thinking about it. If you do this, we will consider that this is unreasonable. We will impose additional tariffs on you. Now, to conclude, because, and my
We're
apologies.
about out
in
of time,
advance,
yes, so go ahead.
but I'm going to conclude. This is my last slide. What do we have
Okay.
ahead in terms of this? July 2020, we should have some update. October 2020, maybe we will have some agreement. Currently, the scenario that is expected is the following. Pillar 2, so that minimum tax, what corresponds to the guilty and beat US regulations, should be decided until the end of this year. Pillar 1, the digital economy taxation, is probably going to be postponed until early 2021. This being said, and apart from the questions, this discussion we may have afterwards, thank you very much. You have my email here if you want to contact me for questions, discuss something. It's always a pleasure. And my apologies once again that I exceeded the time. Thank you.
So Dr. De Silva, thank you so much. As you said, an interesting yet complex topic. Thank you for bringing your clarity to it. So we appreciate it. And we're happy to take any questions you might have at this time. So if anybody has any questions. So could you
Nabil is here as well.
back up again?
Hello, Nabil.
Okay, we do have a question. Let's see here. Oh, please post email again. Actually, Dr. De Silva, I can go ahead and enter it into the chat box if you can.
Okay, I can put it here if you want.
Also, Michael, are you not, you're going to send out the slides to participants?
Yes, I just wanted to go ahead and put a note out there as any questions are coming in. We will be following up with the presentation from today from Dr. De Silva. We can't thank him enough, obviously, for giving us time out of his busy day to join us today. But we will be sending a copy of this presentation out to all of those that have participated. We will also be putting a recording out as well once it's edited up of today's discussion. And that will be coming also with your certificate of completion for CPE credit hour. Usually it takes about 2 days for us to put those all together because we do have to create all of those individually. So just give us a couple days and then we will be sending that out to the email address that you registered with. And so I'll put the note out there again. It's in the chat box as well. Please do put please do send me an email as well at michael.wallman@uta.edu if you did not register for the class through corporate education website. We do have a comment from Professor Burns, who's actually going to be one of our upcoming speakers on FACTA in early August. He said, good presentation, Dr. De Silva, liked that. And of course, the US practitioners win in the global race for tax risk billing.
Yeah, I mean, I understand this is a very complex, it's a very complex rules, but something will come out of this. I mean, Pillar 2, actually, you have it already in US law. I think it's one of them is Section 54, I believe, and the other one I cannot remember. But if you go to the IRC, you have already the guilty and the beat there. And for taxing digital economy, it's just a matter of time.
Yeah, I wanted to add that I've seen a lot of slides trying to explain Pillar 1 and 2. These are the best. And I'm not just saying that because you're a good friend. These are the best and clearest I've ever seen. So for the participants that are hearing this, we want to get them in your hands. I think it's a great way to try and understand this complex area.
Thank you. Thank you very much.
Yes. Mike, do you want to just say quickly who's coming up?
Yeah, so we, as you can see there, have just added a slide of our upcoming speakers to finish off this summer's taxation series. We are excited to be welcoming Dr. DeWitt from Texas A&M Law School on July 22nd, speaking about the future of analytics and technology from a risk management perspective. And then on July 29th, we will have Dr. Toledo, who is going to be speaking about tax technology and the future of tax departments. And as you can see, finishing off there with Dr. Burns, speaking about FACTA. If you have your smartphone ready, you could actually shoot that QR code right there in the right corner if you want to get registered for any one of those upcoming info sessions. So just go ahead and scan right over that with your camera, and it'll take you right to our registration form. But otherwise, again, I think Dr. Silva, are you joining us from Portugal today, is it?
Yeah.
All
exactly.
right. Well, all the way across the world. So we can't thank you enough for being with us and being part of this taxation series. I can speak personally from the Fort Worth campus. We are very excited about the new UTA Corporate Education Hub initiative that we have here. This is a part of, and we are excited to welcome you when we get back to a physical campus to our space and being able to share your expertise over there at our campus.
Thank you very much. It was my pleasure. I truly enjoyed. Thank you very much, Mike.
So thank you all. Thank all who participated. Thank you, Mike, for your stellar job. And once again, Bruno, you're interesting as always. So you point.
Thanks so much, Bill. Thank you. Thank you for inviting me.
All right. Take care, everyone.
Thank you. Bye-bye.
Bye-bye.